let's talk a little bit here about what we've seen so far this earnings season. What you found encouraging, and more importantly, if there's anything that is causing you some concern.
Well, look, we think earnings, by and large, have held up better than expected. It's very interesting to see companies preemptively ahead of a recession, even if we don't get the recession, having layoffs, cutting expenses, trying to preserve margins. And so overall, I think the corporate earnings picture, while earnings have come down clearly, is still a healthy one and is still relatively bullish as a backdrop for the market.
Hank, before the break, we were talking a little bit about your views that the January rally is probably unsustainable considering the constituents that made up that rally. Can you talk to us about where you're seeing more sustainable growth opportunities or where you're seeing more sustainable investment opportunities emerge in the equity market, whether it's at a sector level or at a factor level? Where are you starting to think about putting money to work?
Well, look, we always have money to work. We're always fully invested. And as I mentioned in the previous segment, healthcare remains one of our heaviest weighted sectors. But we have exposure in technology, in industrials. Many of the industrial companies have reported very good earnings. Honeywell, as an example, very recently. And so even some financials we like as well, JP Morgan, BlackRock as an example. So look, we're seeing good dividend increases. Last year, we had dividend increases among all of our portfolio companies at an average rate of 9%. So we think that's very healthy, and we think that's very good in an inflationary environment. But clearly, inflation is coming down, and whether they can get to that 2% by year end is another question. So yes, earnings are coming down. But they're not as bad as previously expected, and that seems to be a refrain almost every quarter.